There's a difference between just guessing at a high or low of a chart or using the logic behind the AT high-low reversal strategy trade to put one on. One that you see the odds are tilted in your favor. So let's take a look at what I mean by this in the following. What I'm going to show you is the price action from January 10, 2022 in the Eurodollar to reinforce and reemphasize the strategy, in this case the high-low reversal strategy of the low of the day, as explained in detail in the AT Trading Study Guide. Now, the first thing we do when we open our charts is we drill down. Remember, a lot of this price action down here had not taken place yet. And the first thing that caught my attention was the failure to take out this level here on Friday at 113.66 days on Monday. So we had a double top here. And why is that important? Important is because the key levels are not until here and not until here. We have a range within this key range over here. And if you're looking for where the stops will be, the key stops will be above here or below here. And unless this was taken out, market can't go after the key stops. So when this was failed to be tested overnight, the opening of the week, markets start to move to the downside. I'm not going to focus on this move to the downside, but it certainly was one that was catchable and tradable. So we point out 113.66 on the upside, 112.84 on the downside. Those were the levels I noted down as I started to drill down. Now I drill down to the 1 hour chart. And similarly, we got 113.66, 112.84. So we know where the key intermediate levels are before I even start trading. So now I'm going to go down. I said I'm not going to go down catching this move to the downside earlier over here. I'm only going to focus on this right here. So we know this level at 112.84, this is just above it, was the key level on our charts. We saw it on a 5-minute chart, we saw it on a 15-minute chart, and if we went to other charts, the 30, the 1 hour, those levels are all here. So we got to the 15-minute chart, for example, or the 5-minute chart. What do you notice? We have a directional indicator. Directional indicator off a low, and once the second line was formed, it offered some protection. If you would have waited for this line to be confirmed and bought the next opening price, you would have been long at 112.84 with a stop below 194. I'm sorry, with a stop below 112.84. On a 15-minute chart, you might have gotten in a little bit later, but it reinforced what you saw in a 5-minute chart, was a directional indicator off the low of the day and also off of a key level, key older line that we saw when we drilled down. So the key takeaways here and approach trading, when we did the drill down looking for a side to trade, we picked out the key levels in the market. We kept them on our blotter. We knew where they were. When the market moved lower and formed this directional indicator after failure to take out this level, indicating similarly where there were no stops on the upside at 112.1366. There were no stops around here at 112.84. Once this directional indicator was formed, we knew where our stop was. As long as this level held, we had some protection. You go long, and you can see what happened afterwards. So that's just to reinforce using a drill down, waiting for the low of the day to be put in, and then using the directional indicator to put on a trade using the high-low AT reversal strategy.